If you've ever spent much time reading, either in books or online, about the different types of accounts that you can use to save for retirement, you've likely seen some arguments from various financial experts saying that Roth IRAs are one of the best. So when I got a question on one of my earlier videos about how to use Roth IRAs, I knew that I had to talk about these two very specific but very powerful Roth IRA strategies. The first strategy is called Backdoor Contributions, and the second strategy is called Super Funding of a Roth IRA, also sometimes called Mega Backdoor Roth Contributions. But not everyone is eligible to use Roth IRAs or these specific strategies, so you really need to do your research or seek some professional tax advice before you implement either of these strategies in your own retirement plan. In this video, we're going to cover what these two strategies are, and stick around to the end because I will tell you just how I put about $40,000 a year into my Roth IRA. The first Roth IRA strategy that we're going to cover is a backdoor Roth contribution. I don't actually use this strategy myself, but I know of a lot of people who do, and it can really be a good way to get access to Roth IRA accounts when you otherwise may not have been able to. But as always, consult your financial or tax professional before implementing any financial strategy in your own life. You see, people who earn a lot of money are not eligible to contribute directly into Roth IRAs at all. In 2021, a single individual who earns more than $140,000 in modified adjusted gross income is phased out of this eligibility per IRS rules. This phasing out also applies to married couples who filed jointly and earned a combined modified adjusted gross income of above $208,000. It also applies to married couples who file separately and earn almost any income at all. And if you know of the huge tax advantages that Roth IRAs can offer later in life, then you know just how much these people are being disadvantaged by not being allowed to use them, at least from a tax perspective. The general premise of a backdoor Roth contribution is that you open a traditional IRA, make a contribution into that traditional IRA that's non-deductible, so you're not taking a deduction for that contribution, and then later process a Roth conversion from that traditional IRA into the Roth IRA account. However, there are several variables with each of these steps that can make this a really complicated transaction from a tax perspective. And keep in mind that this strategy is also still limited by the annual contribution limits in Roth IRAs, which for people under age 50 is $6,000 a year right now, and for those above age 50 is $7,000 per year. There are also other very important things to consider here, like any existing basis if you already have a traditional IRA, making sure not to take a deduction on the retirement account contribution, and the specific paperwork that is used to process the conversion into the Roth. A mistake in any of these areas can create a serious tax issue. So again, do not do this on your own. Seek the help of a qualified tax professional. Now the next strategy is a big one. Very few people know about how to get more than the annual contribution limits into their Roth IRA accounts, and even of those people who do know how, even fewer of them choose to utilize this rule. This super funding strategy does have its pros and cons, but like I mentioned at the beginning of this video, this is exactly how I'm able to put about $38,000 or $40,000 into my Roth every year. And someone could do even more than that if they really wanted to, subject to the all-in 401k maximum contribution, but that's another story. To utilize this strategy, you need to be working and have an after-tax provision in your 401k plan through your employer. There's a common confusion that happens here between Roth 401k and after-tax 401k plans, so let me be very clear. Roth 401k plans will not work for this strategy. It has to be titled after-tax 401k. I know that they sound like a similar thing, but a Roth 401k just will not work. The IRS tax code does not allow for early distributions from Roth 401k accounts, only out of after-tax 401k accounts. So you need to be putting money each week from your paycheck into the after-tax 401k plan balance. But be aware that even doing this can have some drawbacks. You could lose some of the employer match or free money that gets deposited into your pre-tax 401k plan if you were to completely stop using that pre-tax plan balance at all and make all of your contributions after-tax plan contributions. If your plan is what's called a safe harbor 401k plan, then you don't have to worry about this because your employer is required to make a certain minimum contribution into that pre-tax plan balance no matter what you do. So again, there's a chance you might miss out on some free money. Double check your plan rules to know for sure. But you're also going to end up paying more taxes in the current year because the contributions you make to an after-tax 401k plan are not sheltered from taxes or deferred from taxes like regular 401k contributions or pre-tax 401k contributions are. This is why some people that are in very high tax brackets will pass up on this strategy. They would rather tax defer now and put their money into the pre-tax 401k plan and avoid paying taxes at their current really high tax bracket in the bet that in the future they're going to be at a lower tax bracket when they have to take that money back out. So they're going to have some tax savings there. Personally, I'm okay with where my marginal tax rate is at right now, and so I'm okay with paying the tax out of my paycheck each week and then having the money get deposited in my after-tax 401k plan, knowing that once per year I'm going to do the conversion to my Roth IRA and all that money is going to grow tax-free and be not taxed as income in the future. You could argue that there's sort of a sweet spot in the income tax brackets, and I would say it's a pretty wide sweet spot. But where you're at the point that you have enough money to already be maxing out your Roth IRA, which is $6,000 a year, and then you're to the point where you want to be adding more money to that, but you're not earning so much money that by putting money into your after-tax 401k plan, you're paying like 25 or 30% taxes on those contributions, because there's a chance that might end up being worth it for you. After you've been contributing to your after-tax 401k plan balance for some time, the second step is to process a conversion out of the 401k plan and into a Roth IRA account. The logistics of this second step can be extremely complicated, so I don't want to get into the specifics of that at all right now. I just want to issue one main warning if you're ever considering this strategy, which is that you need to be very careful about how the earnings in your after-tax 401k plan account get treated during that transaction. Now listen, I'm a financial advisor. I do this type of transaction at least a dozen times a year, but the first 5 to 10 times I did it, I didn't really know what I was doing, and please do not expect that the representative that you get on the phone from your 401k plan custodian is gonna know what they're doing at all. This is a really rare type of transaction. They're not gonna be familiar with it, and this could easily get messed up if you're not very confident about what you need to tell them to do with your money. But if done correctly, the result of this transaction is a transfer of however much contributions are in your after-tax 401k plan balance into your Roth IRA on top of the contributions you already made into your Roth IRA. Again, for me, that's $6,000 per year. So I'm getting an extra about $35,000 after each year of contributions that I put into my after-tax 401k plan, all now going into a tax-free retirement account. And then the final part of the strategy is the easiest one, and that's what I just mentioned. It's the regular Roth IRA contribution. I just do it as $500 a month, but if you have a huge chunk of cash that you're not using, you could just stuff $6,000 at the beginning of each year, like January 2nd or something, into your Roth IRA account, assuming you think the market's going to go up from that point forward. I don't know, that's your call. But again, just making those regular Roth IRA contributions, if you're below the income brackets, if you're eligible, is a pretty straightforward transaction. And that's how it's done. My own plan is to continue using this strategy either until the tax brackets get raised fairly significantly, or I am earning an extra $100,000 a year and my income bracket is just bumped up. Because at that point, I think the effective tax rate that my wife and I would be paying would be higher than what it probably would be when we're retired. So at that point, it's not worth it to pay the taxes now to avoid paying a lower tax rate later. You're just going to have to do some guesswork there and projecting on what you think it's going to be. But point is, I'm going to utilize this strategy for at least a little while into the future. There is one major political factor that could potentially be throwing a wrench in this entire super funding strategy, though. A part of Joe Biden's tax plan when he was a candidate for presidency included a provision that made 401k contributions no longer deductible, so you still would pay taxes on even the income that you're putting into your pre-tax 401k balance, but then on the amount that you put into your pre-tax 401k plan balance, you'll get a government match or government subsidy of like 26 or 28% that also gets stuffed into your pre-tax 401k plan balance somehow. I don't know the logistics of it. It seems like it's going to be extremely difficult for like the TPAs and 401k custodians out there to handle, but the idea is that everyone is getting like a 26% deduction so that people who are in really high income brackets are not more advantaged by being able to avoid their current income by deferring money into their pre-tax 401k plan balance relative to people who are at lower incomes, because say their tax rate's only 10% and they put money in their 401k, they're only saving 10% taxes on those contributions, whereas someone who makes a lot of money is saving a lot more in terms of the taxes they would have had to pay. So by giving every single person a credit based on a percentage of the money that they contribute into their pre-tax 401k plan, it will hypothetically level the advantage that making that pre-tax contribution gets you from a tax perspective. Again, this was all included in his tax plan while he was campaigning. I haven't seen if this provision is going to be included in the actual tax plan that either gets pushed through Congress or potentially passed in the future, so we'll just have to keep our eyes out. But point is, if this did happen, it would likely create some real difficulties for the after-tax 401k plan strategy. I don't know what difficulties specifically, but like I mentioned earlier, this is such a complicated type of thing for these 401k plans to manage that I feel like it's just going to change the dynamic between how pre-tax versus after-tax 401k plan balances work, and also what you can do with pre-tax and after-tax 401k plan contributions. And so hopefully this doesn't kill the strategy in the future. Hopefully when people watch this video a year from now, this super funding strategy is still something that they could actually utilize and not something that's just a thing of the past, but it could be changing in the future. So whenever you're watching this video, please make sure to double check on everything that I've talked about and check that Congress hasn't changed how any of this works for you. If you've gotten to this point in the video, I really appreciate it. It means you watched the whole thing, and the YouTube algorithm loves the long watch times in terms of total minutes watched or just a percentage of the video. You can check out either of these two, and if you could also like this one and subscribe to the channel, both of those things help me out and I very much appreciate them. As always, thanks for watching.